80% of active fund managers are failing behind the major indexes. Does it mean that regular investors have very little chance to beat the market? Hell no! It is often presented as even market professionals who manage the largest funds cannot outperform the S&P 500. What are you hoping for? And then they're trying to convince you to trust your money to the professionals and or buy financial advice. However, you shouldn't take it that way and think that outperforming the index is so difficult. If we understand how funds work, we can guess why their performance is pretty weak. Of course, everything is much more complicated than it seems. First of all, different funds take a half or 1 or 2% for management expenses per year. Some may take even more. Accordingly, every year the entire fund deducts a certain amount of expenses for the maintenance of this fund. Let's say that the shares held by the fund for 10 years grew by 20% per year. Thus, the profit for 10 years amounted to 519%. If we take into account the fact that every year 2% was spent on the maintenance of the fund, then the profit for 10 years will be only 403%. It is clear that on the 20 or 30-year horizon the difference will be much greater. And we can see that in the statistics. The longer they invest in term, the less likely funds outperform the index. Don't forget about taxes, especially for active funds that make a lot of transactions. The index funds buy and hold style doesn't trigger large annual capital gains tax. Investors who buy an actively managed fund can improve their odds of choosing a winner by buying a lower cost option. Actively managed investments charge larger fees to pay for the expensive research and analysis required to beat the index returns. But although many managers succeed this goal each year, few are able to beat the market consistently. Underperformance tends to correlate with higher costs, according to Ben Johnson, director of global ETF research for Morningstar. The cheapest active funds outperformed about twice as often as the most expensive ones, 35% versus 18%. In the decade through December 31st, 2021, Morningstar found the average asset-weighted fee for an index fund was 0.12 in 2020 versus 0.62 for active funds according to Morningstar. Another reason for the weak results of the funds, they manage large amounts of money. When you have $20 billion under management, you either need to diversify a lot, and the statistics also show that the more you diversify, the more likely that is your returns will be close to the indexes. Or you have to invest in large cap companies that grow much slowly than small cap companies. Also, do not forget that with large amounts, it is more difficulties for funds to buy and sell at good prices. We, as investors of small amounts, have the opportunity to wait, and as a rule, liquidity providers can easily sell or buy our shares at regular prices, while funds cannot always buy or sell the required volume of shares due to the fact that there is not always enough liquidity, and large transactions also can affect the price. So there is absolutely nothing surprising that passive funds that make a minimum of transactions overtake active ones in terms of profitability. Another very important factor that definitely affects the performance of funds is the behavior of clients. Which fund do you think will be more interesting to clients? One that invests in all sorts of advanced technologies, or one that, for example, invests in the financial sector or real estate? Yes, of course, funds must somehow interest clients, and this in turn makes investing less flexible. An ordinary investor can easily invest in companies in South Korea and China and India, partly in the technology sector, partly in the financial sector, partly in the healthcare sector, and they do not need to interest other investors in any way with some specific innovating investments in something very progressive. Also, clients can come and demand their money back at the most inopportune moment for the fund. And that's usually exactly what happens. Imagine the market is falling, your positions in the fund are red. And since the market is falling, then there is a crisis in the financial system, people need money and your clients too. In this case, you will have to sell with a loss in order to return the money to your clients. The inflow of money into funds almost always happens when the fund shows good growth and good results. And when the fund underperforms the indexes, there is an outflow of money even though the results for just 1 year mean practically nothing. Wharton finance professor Jeremy Siegel says that as a rule of thumb, a manager must produce 10 years of market-beating performance to make a convincing case of forced skill over luck. In 2012, the National Bureau of Economic Research published a report stating that consultants are just as likely as their clients to chase results instead of taking a disciplined approach to asset allocation. The authors stated that the market for financial advice doesn't serve to remove client bias, but actually exaggerates biases that serve the advisor's financial interests while earning on those that are not rewarding. Is this a consequence of the fact that funds have to work in such a way that clients do not take away money, or managers simply repeating the same mistakes as ordinary investors? Probably both. Considering that funds with huge money themselves can accelerate the value of shares with the help of clients' money, it turns out that some funds generally work on the principle of a financial pyramid. First, there are many new clients who bring a lot of money to the fund, it invests in the same shares, then these shares are growing, the fund shows high paper profit, and then the only question is who will run away faster. This is roughly what happened to Cathie Wood's funds. Just 2 years ago, Cathie Wood's praise could be heard from every teapot. Now either curses or nothing. To be honest, I hate this behavior of the crowd, which constantly supports the winner and hates the loser regardless of morality. And this is pretty much all I wanted to tell you this time. I hope you like my small article. Thank you for listening.